This video is going to teach narrow range breakouts. And narrow range basically means the market had very low volatility and it's more likely to trend, or volatility is likely to come into the market in the future. Trends make it easier to trade because you know when the trade doesn't work, you're going to have a small loss, but when the trade does work, you're typically going to have a much bigger win than normal. So if you catch a 30 or 40 or 50 pip win, that really gets rid of a lot of 5 to 10 pip losses. So narrow range patterns show up on the chart with yellow lines. We primarily use 4-hour narrow range patterns. So during the previous 4 hours, you can see it didn't really move that much. In fact, not only did it not move that much, but it moved the NR4 bars. Basically means the previous 4 hours were contained within the previous 4 hours, which is the high and the low. Very low volatility pattern. And when it breaks out, you're likely to get some profits. So you can see when this broke out right here at around 90, the first trade didn't work. You got pretty much out at break even. Market's just kind of hovering sideways. It's above the hourly, so it's more likely to go up. Underneath the hourly, it's more likely to go down. You might have bought this trade right here at 88 later, and again, it failed to go higher. So anytime that these don't break out to the upside, it's very likely to go to the downside, and you can see that's exactly what happened. Because the weekly and monthly trend on this currency is down, when it broke underneath the hourly, you might have went short right here. You would have lost 10 pips. And then on the next trade, where it breaks through the low right here, you go short again. You always draw your fibs on the chart. And it came down to the 1.618 area. And so you can see short at 72, out at 52. You made about 20 pips. So you had a break even, 10 pip loss, and a 20 pip win. And you know, some of these breakouts tend to go immediately. Other ones just break out, have false breakouts, and then the big move is to the downside. Today it had a false breakout up and went down. It has a nice little reversal double bottom right here. You certainly can trade this and take this trade right here. That was a small profit. And notice when it broke out above here, the trailing stop kept you in it all the way up until 73. I wouldn't have bought down there, but you can clearly see our statistical tools show the momentum move up with a lot of momentum. You don't know if the hourly here is going to hold and for it to go down. If you did sell right here, guess what? You have another tiny loss. You flip and go long when it goes above the hourly here at 82. And more than likely, you're going to want to get out of this when it hits the upper containment band, 10-day moving average. A lot of times, probably 60-70% of the time, it doesn't go above the upper white band here. And it doesn't on this one either without a little bit of a pullback. So you're out of your trade somewhere up here at 35. You're in this trade at, let's just say 80 or 85. You made 50 pips on that trade. And it's really up to you whether you want to buy this next pullback. But on a range bar chart, it's very clear. You have a nice, beautiful pattern on the range chart. Look at the statistical build your own trend tool. It's just off the charts momentum. Here's your first pullback. And a 3 to 5 bar pullback is usually pretty safe on a range chart. You go long, especially when it goes back above the previous day's high here at 21. And our trailing stop gets you out here at 77. So even if you missed the first move in this big move up, the second wave really took you to the top. And you always want to draw your fibs on the first wave to get an idea. Notice almost to the pip at the 1.618. Most of the time, probably 80% of the time, the market does not go and stay above the 1.618. It might go 5 or 6 pips above there and then comes down. You're usually better off getting out to 1.618. The range bar chart also lets you spot patterns you can't see on regular charts. If the bar doesn't move 6 pips, there's no new bar. Every time it moves 6 pips, there's a new bar. Let's look at some other examples. Pound dollar had a narrow range pattern. And in fact, this one's an NR7, which means it had the tiniest range over the previous 7 bars. Each of these bars was a 4-hour time period. So over the last 28 hours, it's had the lowest volatility. And so when this one broke out right here, you might have had a loss or two. The market went sideways. I might have bought it again right here, had another loss, and kind of waiting for it to break out above the 10-day moving average, previous day's high. And when it does, at 45, you can see the trailing stop got you out here almost 100 pips up. So even if you took 10 trades in this and lost 10 pips each time and lost 100 pips, you got it all back in one trade. And you wouldn't have lost 10 pips 10 times in this. You might have taken a trade here, bought again here, and had 2 losses. The third trade really had a nice little 30 pip win, and then the fourth trade went up 100 pips. Here's a range bar chart. And notice if you bought that little pullback right here, you have a bunch of really tiny losses, and then you have nice 50 and 75 pip profits. Euro yen. Now this one's a little bit higher probability in my mind because the daily, weekly, monthly trend are all up. So I'm not really wanting to sell this, but if I do, notice it went down enough that the trailing stop got me out pretty much at break even. You really want to wait for that false breakout low to get broken before you go short again, and it never does. So it kind of goes back up above the hourly. All the time frame trends are up, and when it finally does break out right here, you have a small, maybe 10-15 pip win. The second trade right here at 40, you're out up here at 70. Nice 30 pip win. Again, 30 pip win gets rid of a ton of 5 to 10 pip losses. Dollar Swiss. This one's underneath the hourly, so it's more likely to go down. You don't want to buy the breakout of these narrow range patterns when they're underneath the hourly. Only buy them when they break out above. When it's above the hourly, only sell them when they're underneath the hourly. Now here's the lower containment band, which oftentimes is the end of the move. So this is a little bit riskier. I prefer when these narrow range patterns are sitting right at the hourly and they have a very good number of 30 to 50 pips to go before they hit the lower band. This one right here is at 16. This breakout is at 22. It's only 6 pips down. So it doesn't really make that much sense to sell this. But if you do, be aware as it's going sideways right here, the weakness disappears. You might want to just get out of this with a small 5 pip loss. You go short again, you lost a little bit more. And it's anytime you get a false breakout to the downside, usually it has a big move up. So when it goes above the hourly right here, you're long. You only made about 10 pips. Went right to the monthly R1 level. You always want to draw your fibs on the last wave down to get an idea of where the fib targets are. This is the 38% retracement level right here. So when it can't get above that, guess what? The false breakout to the downside, tried to go up, it couldn't. I would really wait for it to go underneath the hourly right here just to be safe. And if you wanted to buy this pullback right here, you certainly could, but notice our trailing stop is above price. So our automated trailing stops have this in a short position, and you're short, and it just goes right to the lower containment bands, which typically is what happens. Notice on this little pullback right here, there's almost no strength. Very high probability short. You draw your fibs on this last wave, and most of the time, like I've said in class thousands of times, the 1.618, if it breaks through the first fib target, I typically just exit the whole trade right here. Let's just say it's 60. So this last trade you short at 97, out at 60, you made 37 pips minus your spread. Again, that gets rid of a lot of tiny 5 to 10 pip losses. So that's why I like these narrow range patterns. They don't always work immediately, but eventually, they lead to big trends, which allow you to have a big win, which gets rid of a lot of the losses. Let's look at the dollar CAD. This one has really a mixed trend. The weekly trend keeps shifting up and down. It's very choppy right here. But if you bought that breakout right here, again, notice the trailing stop got you out pretty much near break even, so you didn't have much loss. When it broke out again right here, you didn't make much. You got a ton of resistance above you. It's typically not wise to buy a currency that is not likely to give you at least 20 pips profit target. So if you're going to buy this when it goes back above the hourly here at 24 and your next profit target's at 31, that's not even 10 pips up. So that's one of the reasons why this really wasn't that good of a trade to the long side. But when it comes back down to the hourly right here, you might have decided to get into that. But again, notice the trailing stops above the price chart, which means our systems are actually short. And you might be better off waiting for it to break down right here and out maybe at the trailing stop. The lower containment band is always a good place to get out of half. Notice this fell without extreme momentum. If it's underneath the 80 level, it doesn't have that much momentum. So this is very likely to be the end of the move. And it also was a whole number, which tends to have big buy orders there. So I would have exited half the trade here when it kind of went up, came back down and didn't break this level. I would have probably got out of the second half at 90.05. So let's just say our average exit was at 05. We're short this at 20. We made 15 pips. So again, if you took every one of these trades today, more than likely you broke even or made a few pips on this, and this is probably the worst example I have today. The Australian dollar broke out. Unfortunately, the weekly and monthly trend is very much to the downside. But again, price went up enough that the trailing stop got you out right here. Pulled back to the hourly. The momentum was slowing. You might have went long right here. You made a small, maybe 4 pip profit. It's kind of going sideways. If you went short right here, notice the trailing stop got you out pretty much at break even. And anytime you have a false breakout up, false breakout down, previous week's lows right there. That's a major support area. Didn't have that much weakness. I might have went long right here when it broke out above this bar's high. It didn't quite stop us out, and then it went up to the high. But regardless, if you took this trade here, you made a little bit. Came down to the hourly, bought here, you made a little bit. When it broke down underneath here, you got out of break even. That's the benefit of trading with this method. Let's take a look at the Australian yen. This one also had a breakout. All the time frames are up, and this is what typically most happens. It's above the hourly. The narrow range pattern happened right near the hourly, which I always like. And here, because if it goes to the upper containment band up here at 42, you buy the breakout over the previous day's high at 04, you have a 30 or 40 pip range to profit on. So I probably would have bought right here, got out with the trailing stop, got hit. Unfortunately, had to jump right back in within 10 minutes. In the second trade, went from around 10. And I would have probably exited somewhere up here when it went sideways out around 36. So it went up 26 pips. And using support resistance in combination with the narrow range patterns, you wouldn't want to buy the breakout of this because the previous day's high is only a few pips above it. It's only 2 or 3 pips above it. So wait for those extra few pips. Was kind of like an insurance policy. And unfortunately, it didn't explode up at first. Kind of went sideways for an hour, and then it exploded up.